Distinguished Financial Secretary Paul Chan, SFC Chairman Tim Ray, and Chief Executive Julia Liang, dear colleagues and friends, it is a great pleasure for me to speak to the Hong Kong SFC Regional Securities Regulatory Leadership Symposium. On behalf of China Securities Regulatory Commission, I would like to congratulate the SFC on the successful opening of this symposium. I also would want to express the CSRC's appreciations to securities regulatory colleagues and international investors who have followed, supported, and participated in the development of China's capital market. In accordance with the symposium's purposes, let me take this opportunity to share with you my observations on China's economic prospect and the connection between capital markets in Chinese mainland and Hong Kong. China's GDP grew 5.2% last year. Consumption measured by retail spending went up by 7.2% and accounted for 80% of GDP growth. This was the highest level of consumption contribution to growth in China. China remained an important driver for international economy, contributing again about 30% of global growth in 2023. What is more important than these numbers has been the solid progress in driving high-quality development. In this regard, I'd like to highlight two areas. One is digitalization of the economy. As technologies such as cloud computing, big data, artificial intelligence, and blockchains are increasingly adopted in China, traditional manufacturing and service industries have stepped up towards digital transformation, unleashing huge productivity gains across a host of industries. Furthermore, the Chinese economy is ideally situated for digitization. Given its vast domestic markets, almost unlimited supply of engineers, and an excellent infotech infrastructure. Today, if a foreign visitor goes to China, he will find quality goods and services offered at much cheaper prices than elsewhere. This is not because of lower Chinese wages, but mainly because of higher productivity gained through digitization and keener competition. Current low Chinese CPI and negative PPI numbers are caused by a number of factors, among them an insufficiency of aggregate demand. But one factor is very clear, and this is this cross-border productivity gain. The other area I'd like to highlight is green economy. China is a world leader in most green technologies. It accounts for more than half of the world's installed solar power capacity, has over 20 million electric vehicles in use, and is the main supplier of batteries to leading EV manufacturers worldwide. Last year, China surpassed Japan for the first time as the biggest car export due to a surge of EV export. Propelled by demand from its large domestic market, Chinese EV makers will continue to advance in scope and scale despite recently reported trade frictions. As green energy, green transportation, and green lifestyle sweeps through the world, Chinese green tech companies stand to gain disproportionately At the current level of income per capita, China should have a higher proportion of consumption in its GDP composition. International analysts are closely watching the unfolding of consumption in the Chinese economy. The aforementioned last year's consumption number gives some hope that consumption has finally stepped up to become a larger driver of growth. Travel and spending figures during the recent Chinese New Year holidays offer corroborating evidence that the tentative consumption expansion has some staying power. There is a huge pile of savings in China's banks, and much of it can be drawn down for consumption. So if consumption pickup is sustained, then it is a game changer for the Chinese economy. Let me now turn to the close relation between Hong Kong and Chinese mainland's capital markets. Hong Kong is a free trading port with a freely convertible and reliable currency, an excellent legal system, and a superb capital market infrastructure and regulation. Its capital market can both serve the Chinese economy and leverage its vast resources to attract international investors and issuers. This is an advantage unmatched by any other international financial center. The Stock Connect scheme offers an outstanding example of this advantage. Since its launching nearly 10 years ago, it has channeled 1.78 trillion RMB international funds into China's A shares in northbound trading, infusing a significant amount of much-needed institutional money into China's capital markets. Southbound trading was enthusiastically embraced by mainland investors, who now owns Hong Kong stocks worth more than 2.2 trillion Hong Kong dollar, providing vital liquidity to the market. To no small measure, the Connect scheme solidified Hong Kong as a major international asset management center. The successful listing in Hong Kong of some of the most well-known Chinese companies was due very much to this scheme, as is close to 60% of the 112 recently approved Chinese companies choose Hong Kong as their listing venue under the new overseas listing filing mechanism instituted since March 31st, 2023. Over the last 30 years, the CSRC has steadily deepened relations with SFC and the broader Hong Kong capital markets community. The pace of deepening accelerated markedly after the Stock Connect scheme. Today, CSRC and SFC work more closely and effectively than any other two independent securities regulators. We jointly hold a high-level meeting twice a year to discuss comprehensively issues regarding cross-border supervision and enforcement and the development of the two capital markets. There is an active program of seconding staff to each other. Enforcement officers meet regularly to help each other on cases based on IOSCO protocols. Both CSRC and SFC are determined to make sure that regulations in both markets follow world standards and best practices as cross-market transactions fast increase. The close coordination and mutual support between the two regulators has produced important benefits for both markets. Hong Kong launched Asia stock futures trading to provide risk management tools for northbound investors. RMB-denominated trading counters were set up in Hong Kong to enhance the use of RMB in stock trading. International company stocks have been included in the Connect scheme to help attract issuers to come to Hong Kong from all around the world. Under the clear direction of the Chinese central government, the CSRC will continue to take practical measures to support the growth of Hong Kong's capital markets and make an even better use of the synergies between our two markets. Hong Kong remains a unique and highly valuable asset in China's modernization. Hong Kong people are enterprising, resilient, and optimistic. Therefore, to bet against Hong Kong would require a great leap of faith. Thank you, and I wish the symposium a great success.